Hey, so in this video, I'm going to walk through our financial projection template built specifically for strip mall investors that are looking to acquire a strip mall, perhaps renovate it, probably increase the rent rates, maybe implement your new management team or process, and ultimately increase that net operating income so you can increase the value of the property and provide a return to your investors and lenders in this case as well. I'm going to walk through how to fill this template out, kind of walk through at a high level what you get in the template so you can see if it's a good fit for what you need, and then go back into more detail about how to fill out each section of the model. We have put a link to the template in the description of the video below. And also, just as a note, this is going to be a bit of a long, kind of detailed video. If you stick around to the end as a thank you, because we know it's a long, detailed video, you will be able to get a discount code. I'm going to give you access to a discount code at the end of the video as a thank you for sticking around. Just a little bit of background about me before I dive in, just to kind of set some context. My name's Adam Huxama. I'm the co-founder of Projection Hub. I spent about a decade as a SBA lender, a small business administration lender. And during my time as a lender, we were often asking our clients for financial projections, which is what kind of gave me the idea for Projection Hub. And I thought, we should be able to build some sort of TurboTax-like solution, a software tool that can help walk people through creating financial projections. And my hope was, hey, we're going to build this monthly recurring revenue, tech startup that, is going to be high growth in all of this. And I learned a couple things along the way. So we built that software application, but our main challenge was that customers need projections for a particular point in time when you're trying to raise capital from investors and lenders. It's not something you want to keep paying for month after month. And so it just didn't make any sense as a monthly software as a service product. The other thing is, as we kept building more features into our app, it just kept getting closer and closer to Excel. We're like, we want to be able to do this thing that you can do in Excel. And we're like, you know what? Why are we doing this? Excel already exists. So we pivoted. We said, hey, we're going to just focus on building the best custom Excel templates that we can that will solve our customers' problems and help them create financial projections. That's really what we wanted to do. And so we've kind of made a shift. And today our focus is, over the last several years, has really been on building out over 100 different custom financial projection templates for all sorts of different businesses and industries. And we have a CPA on staff that helps customize the models as well for our clients. And so today I'm going to be walking through this strip mall acquisition and renovation template, go into a lot of detail here. So, all right, with that, let's dive in. Okay, so we're starting here on the At a Glance tab. And this is kind of at the end of the process. You're going to be able to get a bunch of different graphs and charts that will be able to be put into a pitch deck or a business plan to present to investors and lenders. You're also going to get a 10-year annual cash flow statement summary. We're going to have a 10-year balance sheet summary, a 10-year income statement summary. Also, I'll come back to a couple of these other tabs, but you're going to get a cash flow statement, balance sheet, and income statement all broken down by month for each of the 10 years. So if you need that monthly detail, you have that. Maybe overkill for what most of you are doing, but if you need the monthly detail, it is there. Now, there's also this pre and post acquisition comp tab that I think is pretty useful. So if the case you're trying to make, or the kind of the use case that we're assuming here, is that you've got a strip mall property that you're looking to acquire. The reason you'd want to acquire it is because you think you can operate it better. You think you can earn a return, right? And so in order to kind of demonstrate that, you want to be able to show what was the prior year's financials look like for the property. And then after we kind of implement and stabilize the property under our new process and pricing and all that sort of thing, what's the cash flow and net operating income going to look like? And so we can see here, here's our cash from operating activities and as a percentage of revenue from the prior ownership. And then this would be after, we say post stabilization. So the 12 months after kind of everything has been updated, changed, and implemented. This is what net operating income and cash flow is going to look like after the fact. So one other tab I'll look at a high level here is our input distributions tab, which is going to allow you to do some basic kind of investor distributions, investor returns modeling. So you'll be able to set what percentage of cash does the business hold versus what are you distributing to investors. And so you can see here we said, the business is going to hold 100% of the cash for the first 5 years, and then it's only going to hold 80%. So it will just start distributing 20% of cash available each year. And then you can say, okay, ultimately in year 10, we're going to sell the property at a 6 cap. And based on that, and the net operating income at that time, I think our gross sale proceeds are going to be 4.9 million. Outstanding debt at that time, 1.8. So we'll have net sale proceeds of 3.1 million. The 1.4 million initial equity investment, that's going to produce our internal rate of return here of 11.77% based on those assumptions. Now, you can start to play around with some of this. So you actually see here, we had a refinance and we could actually cash out some of that refinance. So let's say we wanted to cash out a bit more here earlier on. So instead of holding 100% cash reserve, let's only hold 30% cash reserve in that second year. So we're going to distribute a bunch of that cash out refinance basically. And we can see, look, we cashed out a little bit too much. We don't have enough cash to operate here. And so we need to adjust this. Maybe it's 50%. Okay, so we can distribute 50% and still say cash flow positive. Now this should impact and improve our IRR. So it increased it by about 1% based on that. So anyway, that's just an idea to kind of let you play around with that once you're done. Now, that was kind of the high level view of what you're going to get. If this looks like it's going to be useful to you, let's go ahead and dive into kind of the details of how to fill this out. So in the input revenue tab here, we're going to say we're starting the projections in January 1st, 2024. So let's assume that's kind of the date that we acquire the property. And we've got two different unit types, end unit and middle unit. We've got 8 units total. It's a 10,000 square foot facility. So, and then you can put in what was the starting rent per square foot and then what is the forecasted rent per square foot after we implement renovations and increase those rent rates. Now, the other thing to mention here is you can set what month in the model do we expect to increase our rent rates. So maybe because we know when we acquire it, the 2 end unit tenants are going to have 11 months before their lease is up, and we're going to just assume the prior lease. It's going to be 11 months before we can raise rents. So we put month 11, and then we think, you know what, even after that, it's going to take us 6 months to actually get those rents increased. So you can kind of set when will we start raising rents and how long will it take us to raise rents on all the units in this line item. The other thing you can do is add in some different miscellaneous fees. So if you're charging tenants maybe a common area maintenance fee, that could be this miscellaneous fee of $100, let's say. Okay, so let's zoom down here. We can apply an annual rent increase here. We can adjust our vacancy rates here. So we're saying prior year, we had a 12% vacancy. We're going to get that down to 10% stabilized. And then here we can say what percentage of customers or tenants were paying for those different miscellaneous fees. So we're saying 100% were paying that $100 a month miscellaneous fee. So ultimately, this is going to allow you to calculate your gross potential income, your vacancy and credit loss, and your EGI, your effective gross income. Okay, let's move on to our operating expenses tab. So here we can zoom in just a little bit. So we can add up to 10 different expense categories. And then down here is where we'd enter in the specific expenses. So we'll say, okay, we've got interior maintenance, and it's going to be in the maintenance category. And then we can determine what the cost driver is. Is it an entire property, a per square foot expense, or a per unit expense? So different expenses might be on for the whole property. Like the website is an example. You're not going to pay for the website based on per square foot or per unit. You just maybe you have a website for the property and that's it, right? But other expenses like maintenance may be a function of square footage. And so we're going to apply here, we can say 5 cents per square foot per month as our expense here for interior maintenance, and then 10 cents per square foot per month for exterior. Here's another example of a couple of things we can do. So on the landscaping maintenance, let's say this is landscaping and lawn care. Now, this isn't going to be an expense that we have all year because the grass only grows during the warmer months. And so the first payment is going to start on month 4, and it's going to go through month 10. And we're going to pay $2,000 a month during that time frame, and then it's going to repeat each year during month 4 to 10 of each year. So you have quite a bit of flexibility to build in some different ways to account for expenses. There's one more type of expense here to show you. So real estate taxes, we could say this is a per unit expense perhaps. We're going to pay $1,000 per unit. And this is a one-time a year payment. And so it's going to happen in month 4. So we put the first payment month as month 4 and the last payment month as month 4. But then we select that it repeats each year because we're going to have that same month. In the fourth month of every year, we're going to have this real estate tax that we know we're going to have to pay. Okay, so then you can also apply these year-over-year increases, basically inflation, on those expenses. And now these two columns I want to show you are really important and useful here in doing that kind of comparative analysis of the prior ownership to operating under your ownership. So the gray out column is kind of the forecasted expenses based on all these assumptions that you put in. So for example, the maintenance, the exterior maintenance at 10 cents a square foot per month is going to amount to $6,000 a year for this expense, right? And then we're saying, oh, last year they spent $10,000 on this particular expense. So you can see how you can enter in, what the expenses were for the prior year, and then this will compare what you're expecting for your own expenses. Now, before I do that, now we're going to come down to the bottom here and look at, we have the ability to put in a couple of different other types of expenses here. We can do expenses as a percentage of revenue. So if we wanted to say, hey, we're going to hire an operations manager to manage the property, we're going to pay them 5% of total revenue, you can do that here. So this would be for the prior year here if the prior owners had a management company. And then you can also have, let's say we have a general and admin expense, that's a 1% of revenue fee. And finally, you can do a reserve for replacement section down here where you're just holding some reserves on hand on an annual basis for HVAC or a roof or a parking lot, those sorts of things. Okay, so moving on to our salaries and wages tab, we can say, okay, prior year annual payroll expense was $75,000. Maybe they had an on-site or kind of like a property manager staff member. And instead, what we're going to do is have a third-party property manager, which is why we put this operations manager as a 5% of revenue here. And then we're just assuming, hey, maybe we would still need a part-time kind of on-site person that, who knows, maybe they're responsible for many different properties, but they're going to be allocated $25,000 of their annual salary is going to be allocated to this particular property. And you can say month 1 through month 120. So the entire model, you only have one of these employees and you're going to give a 2.5% raise each year. All right, so there's two more tabs. If you'll stick with me, we're almost done. But these two tabs are really important. There's the financing tab and the purchase and renovation budget. Now these are kind of go hand in hand, and it's almost like a circular reference. So what you're trying to do is kind of figure out, okay, what's the purchase price? What do I need to spend on renovations to implement my plan? And then also, can I get the financing to be able to actually cover that? Will I be able to borrow that much? Will I be able to raise that much equity? And so let's start with the purchase and renovation budget. Let's say the seller wants $2.5 million for the property. So we've got a purchase price of $2.5 million. And then we want to do some renovations at $15,000 per unit for all 10 units, which will equal $150,000. We're going to do that through this cost period. So you'll see cost period is month 2 through 8. So it's just kind of over time, we're going to spend some money on renovating those units. You'll notice the cost period for the purchase is start month 1 and month 1, because we're paying it all in month 1 to acquire the property, right? We're not spreading that out. Let's say we're going to spend $100,000 on parking lot updates, and we're going to spend some money on new signage. So this could be $7,500 on new signage for all 10 units. So maybe we're allowing our tenants to get new signs. We're going to cover the signage allowance for all 10 units. And then we're also going to have some new signage for the property as a whole, $50,000 for some new signage, maybe out by the road. And then we have the cost period for that as well. So ultimately, that's going to give us a total purchase and renovation cost of that $2.875 million. And so now the question is, can we come up with $2.8 million to purchase the property? So you're going to go to a lender, and the lender's going to say, well, we want to lend to you based on how the property is currently performing, not how you think it's going to perform after you take over, right? So that's probably what they're going to say. You might be able to try to convince them that, hey, we're really experienced. We're going to implement these processes. We know we're going to improve profitability. So we want you to lend to us based on future performance, not past performance. That might be possible. But let's just assume in this example that they're going to lend to you based on the historic net operating income of the business. And they're going to want you to have a 1.25 debt service coverage ratio, let's say. And you're expecting a 6.25% interest rate for 30 years amortization. All right, so based on those assumptions, we're going to be able to figure out how much of a loan you can get. So we'll look at what was the average net operating income for the prior year. What was $7,565 based on the numbers that we put in for the historic performance. And that means with a 1.25 debt service coverage ratio, the maximum monthly loan payment you can make is $6,000 $52. On a 30-year term, that means your total loan amount could be $982,000. Now, we can look at this section here and say, okay, we're going to increase rents and improve the property, increase the net operating income. And so we say, all right, so after we've implemented, so in month 17, after we've implemented the rent increases and all those sorts of things, what is our net operating income going to look like? It's going to average out at $16,000 a year or a month for that year after stabilization, which means we can afford more in debt service, which means we can borrow more. And so here is the assumption here of a $2 million loan. And so what you might be able to do is borrow the $900,000, roughly $1 million initially, come up with the rest of the purchase price as equity. But then once you get the property up and running and stabilized at this new level, you can do a cash out refinance, get this new $2 million loan, pay back a portion of the equity that was invested. And so that's kind of the idea here, the use case that we're looking at. Okay, so with that in mind, we're going to go ahead and say, okay, you know what? We couldn't make it work with this $982,000, but we were able to convince the bank to actually lend us $1.75 million because we have a great track record. And so they lent to us somewhat based on our future expectations. So let's make that assumption here. So we've got a $1.75 million loan. And then in month 19, after we're stabilized, we are going to do the cash out refinance, get a little bit of additional cash out there around, $300,000, $325,000 cash out refinance. Now, for each of those loans, you're going to have financing costs. We have this set to be a calculation as 2% of the loan amount. But of course, you can make changes to these different financing costs. And then down here, we're going to have our equity piece. So we're going to have a new equity investment of $1.4 million. That's what we think we're going to need to put in. So we'll have 1.75 in debt, 1.4 in equity for total financing of $3.15 million. And our purchase and renovation budget is $2,875,000 plus $15,000 other fixed assets that we need and $80,000 in financing costs is going to leave us with $180,000 in working capital. So you might say, hey, we don't actually need that much working capital. Maybe you can invest less, maybe you can borrow less. You can make those adjustments. In fact, let's just change this to 1.3. It doesn't like that because I have a debt to equity ratio difference up here. Okay, so we still have enough working capital here at $80,000. All right, so now once we've done that, we can go back to our input distributions tab and take a look at, based on the 1.3 million that we invested, the sales proceeds that we're assuming. Well, now I guess when I invested less, it caused us to go negative in our cash distribution. So, I guess I had a good thing going. Should just not mess with that. That's a good example, though. You can kind of play around with this and see whether you have enough working capital. You just want to make sure that this cash before distributions never goes negative. Then ultimately will allow you to see, okay, based on those assumptions, what's our IRR on the investment. So I know there's a lot there. Thank you for sticking around to the end. As I had mentioned, if you go down to the description of the video below, there's going to be a link to a form, and you can fill out that form, and it'll email you our most up-to-date and best coupon code offer that you'll be able to use to get a discount on the template when you buy it. And so thank you again. And if you have questions or you need help filling it out or need help customizing it, we do have a CPA on staff that can help with that. And we'd be happy to record a video like this to answer questions for you or support you in those ways. So you can reach out to us at support@projectionhub.com. We'll be happy to help. Thanks.